I have clients ask me all the time, Tim, how should I buy the S&P 500? I want to be in the S&P 500. It's done great. Over history, it's done great, but I don't want to have losses, especially in retirement. What can I do? What's the right way to buy and still be in the S&P 500 but not have to worry about losses? That's what we're going to talk about today. Let's roll.
Welcome to the Safe Money Retirement Show with your host, certified financial fiduciary, Tim Wood. Tim is a retirement and income planning expert, best-selling author of Safe Money Retirement, Your Game Plan for Success, member of the exclusive Ed Slott Master Elite IRA Advisor Group, and founder of SafeMoneyRetirement.com. Tim uses an education-first approach with clients nationwide to ensure they understand their choices in planning their own safe money retirement. Tim focuses on wealth management, retirement income, tax and long-term care planning, and asset protection and growth strategies. And now, from the Safe Money Retirement Studio in Johnson City, Tennessee, your host, Tim Wood.
So what is the right way to buy the S&P 500 when you're either just getting into or you're already into retirement, or you want to make sure that you don't lose anything when the next market correction or crash happens? What can you do? Is there a right way to buy it and still get the benefits of the S&P 500 but not the risks? Well, that's what we're going to discuss today. But first, do you already have your copy of Safe Money Retirement, Your Game Plan for Success? If not, why not? We will send you a copy absolutely free with no charge and no obligation so you can make a plan that works specifically for your situation. In this book, you're going to learn what options there really are and what you can do to help yourself plan your own safe money retirement. Give us a call right now. We'll send you a copy absolutely free. It's 800-913-SAFE. That's 800-913-7233, or just log right onto our website at safemoneyretirement.com and register for your book there. The S&P 500 is what's called a market capitalization weighted index of basically 500 of the leading publicly traded companies in the United States. Now, it actually includes 503 components because 3 of them have 2 shared classes, but it's considered the S&P 500. People want to be in the S&P 500 because historically it has done fantastic. It's had great returns. It's the 500 biggest companies, so it should be relatively stable, and that's why so many people use it as a benchmark against what's the overall market doing. Because if, those 500 companies are doing great, chances are the market itself, all of it's doing great. If they're doing poorly, chances are the market's doing poorly. That's why a lot of people want to be in the S&P 500. Completely makes sense. I'm in the S&P 500. But how do you want to be in the S&P 500 is the question that we're looking at today. So there's the traditional way to be in the S&P 500. You can purchase the index. You can get it from any brokerage house. Any type of financial advisor can get you into the regular S&P 500. Now, the difference is the regular S&P that you would get from just a regular brokerage house or a regular financial advisor, that is a variable account, which means, of course, it can go up, but it can also go down. And that's one of the challenges with just being in the market traditionally. For example, if you've got 100,000, you lose 30,000 because there's a market crash. Okay, well, you're down to 70, but now you need a 42 to 43% gain just to get back to where you were. That's the challenge being in the market. Now, if you're younger, if you're in your 20s, 30s, 40s, maybe even 50s, that's fine because you've got time to recover. The problem is when you get later in life, or even if you're younger and you've got money you want to make sure you don't lose, having all of that at risk in one of those type of accounts can be a huge gamble. Because if there's a major market event, and sometimes these market events can be completely unseen, they can be brought on by world events. They can be brought on by a war. They can be brought on by another pandemic. Anything can affect the markets. So what is the right way to buy the S&P 500 and not have to worry about the market risk, not have to worry about the global risks that affect the market, not have to worry about the political risks that will affect the market, because we're certainly seeing that right now, aren't we? How do you do it and not have to worry about any of that? Here's how you do it. There are products out there, and there are some of the products that we use a lot called fixed indexed annuities. How these products work, you can buy the S&P 500 in these products. How it works is you're going to get either what's called a cap rate on the S&P 500 or a participation rate in the S&P 500. Let me explain what both of those are. So a cap rate basically means if the S&P 500, now this is in our plans, and the plans that you cannot lose any if the market goes down. They're fixed plans, you cannot lose any. So if you put everything in the S&P 500 for the next year, if the S&P 500 were to go down, you wouldn't have any gains, but you wouldn't have any losses. If you put 100,000 in, a year from now, you're still going to be at 100,000 if the S&P is down. Now, if the S&P goes up between 0 and whatever your cap rate is, you would get that rate. So let's just say your cap rate is 9%. If the S&P were to go up 3%, you're going to get that. If the S&P were to go up 8%, you're going to get that. But if the S&P were to go up 15%, you're going to get 9 because that's your cap. That's how a cap rate works. Now, a lot of people say, well, why would I want to cap my potential growth? Because you're completely getting rid of all of the potential losses. That's the trade-off. You're giving up a little bit of the top end to totally get rid of the bottom end. Again, when you're younger, that might not make sense. It actually does for more and more younger people that don't want to lose any, but that's not necessarily where we're talking about today. But it might make sense for you to stay at risk when you're younger because then you get all of the gains. That's fine. But when you are really trying to plan for your retirement, you don't have time to make all of those losses back. Or again, if you're just of the mindset that you don't want to have losses, period, to ever have to think about, that's how a cap rate works. Is you're going to get, if it goes down, you're not going to lose any. If it goes up between 0 and whatever the cap rate is, you'd get that. But if it grows more than the cap rate, you're still going to be stuck at what the cap rate is. That's how a cap rate works. The other one is a participation rate. Now, the way a participation rate works is it's a percentage of gains you get to keep at the end of a crediting period. I know that sounds like a lot, and participation rate sounds like a fancy term, but all that means is, let's just say the participation rate's 50%. So if the S&P, let's say, were to do 10% over the next year, if your participation rate is 50%, that means you would get 5% credited. Again, why would I not want to get 100% credited? Because you're totally getting rid of the bottom end. Now that 50%, I just pulled that, totally out of the air, because there are participation rates that I've seen that are as low as 20, 30%. And as high some as over 200%. It depends on exactly which index you're in. Are you in just the vanilla S&P index? Are you in the daily risk control S&P index? Are you in the market risk control? There's a lot of different indexes. And you can choose where you want to be. And you will see what the different participation rates are on each one. And of course, you can look at historicals and see what each one has done as well. But basically, that's how these products work, and that's the right way to buy the S&P 500 when you're either near or in retirement, or even if you're a younger person like myself that's still got a ways to go for retirement, but I want to make sure I don't lose any of what I've saved. I still want to have the potential to make really nice gains in the market, but I don't want to have any of the fees and I don't want to have any of the chances of losses. Then this is the right way to buy the S&P 500. And you can do a mixture. Right now, I've got clients that have some in the regular S&P with a cap and some in the S&P with a participation rate and some of the in the other S&P indexes that are available with participation rates. You can mix all of that every year. And we try to make a wise decision every single year to get you the most growth possible for that next 12 or 24 month period, depending on what plan we're doing. So that is the right way to buy the S&P 500, is get into a plan that you don't have to pay fees and that you don't ever have to worry about losses. And then you can choose how your money grows. Like I said, do you want it to go in the cap rate? Do you want it to go in the participation rate? Do you want to mix them? And in some of the products, you've also got the option for a fixed rate. So you can even mix that in. It gives you the opportunity to buy the S&P 500, but not have to worry about any of the losses, and to give you a little bit more flexibility to change up how your money grows every single year.
Do you have a 401k, IRA, TSP, or any other type of retirement account you don't want to leave exposed to the risk of market loss? Have you moved on from a previous employer and have your retirement money just hanging out there in an old plan? You've worked too hard to leave your retirement nest egg to chance. We can help you roll over your retirement account from your past or current employer with no tax consequences and get you in a plan that guarantees you'll never lose another penny of your retirement due to a market crash while still providing market-like gains. Call us now about our current bonus options on your retirement money with a safe, fixed-indexed annuity. Imagine putting your money on an elevator that only goes up. It might stop on a few floors along the way when the market index goes down, but you won't go back to visit the lower floors. Our phone number is 800-913-SAFE. That's 800-913-7233. Call today and get your complimentary Safe Money Retirement Kit with all the details. There's no obligation, so call us now at 800-913-SAFE. That's 800-913-7233.
In today's case file, we're going to look at the story of Mark and Linda. Now, Mark and Linda were doing incredibly well when we got to meet with them. Already had well into the 7 figures in different retirement accounts. And Mark had made a lot of his money over the years in the S&P 500 index and in several of the sub S&P 500 indexes that are based on the S&P 500. So he wanted to make sure that he could still use the S&P 500 and some of those sub-indexes, but be able to cut out any of the losses of any potential market event that could happen at some point in the future. We know it's coming, we just don't know when. He wanted to be able to cut that out, and she especially wanted the security of knowing that they didn't have to worry about losses. So what we did for them was we found a specific type of fixed indexed annuity, again with an A-rated company. We're dealing with A-rated companies. An A-rated company, no chances of losses, and really good chances of gains when the market's up. He chose to put some of the money in the S&P with a cap, which means he can make up to a certain amount. He chose to put some of the money in some of the S&P other indexes that have participation rates. Some can be pretty high. And then he spread some a little bit into the fixed rate. So what does this mean? This means they know that they're going to have whatever they put in the fixed rate. Of course, that percentage, we know how much that's going to grow. We can figure that out. But then if the S&P or any of the sub-indexes is down, his absolute worst case scenario is he wouldn't lose any on whatever percentage he has in the S&P. So let's use some real numbers. Let's say you had an account and you wanted to have 50% of your money growing in the S&P and 50% in a fixed rate. Well, half of your money would definitely grow, and we can tell you what that's going to be because it's a fixed rate. The other half, it depends on whether it's in a cap rate or it's in a market indexed rate as to how much you're going to get. They left totally happy because they knew they weren't going to have any more fees. She didn't have to worry about them not having anything left in retirement. He left a whole lot more satisfied as well, knowing that they were protected, but they still had a chance for really good growth and that they could change how they were allocated every single year. They left happy, and happy clients makes a happy fiduciary. Now, how can this work for you? Specifically, if you are looking to have gains and you are looking to have market-like gains without ever having to worry about any losses, without ever having to worry about any type of management fees, and be able to change how your money grows every single year, one of these plans might be a good fit for you. So these plans allow you to move money from either a bank account and after-tax money or money market or whatever, or 401ks, IRAs, TSPs, 403bs, whatever. We can move money from those plans into one of these fixed indexed annuity plans that has no chances of losses from any market event ever, no fees ever, unless you were to withdraw more than they allow you to withdraw. So it allows you every year then, how much of your money do you want to grow based on what the S&P does in the cap rate or in the participation rate. And then, like I said, in some of them, they've also got a fixed rate that you can choose from, and some have even other indexes. It allows you every single year to choose how do you want your money to grow, and then not ever have to worry about any losses, knowing that even if you put all of your cards on the table or all of your chips on the table and say, I want to go all in on the S&P or whatever, whichever index, worst case scenario for you, if that index tanks and winds up going into the negative, the worst case scenario for you is zero gain that year. That's your worst case ever is 0%. Never going to be any negatives in these plans. So being able to protect what you've got, still have really, really good, strong growth potential, and again, never have to worry about any losses or any kind of market risk. That is what could be a really good fit for you. Give us a call. Let's sit down and let's see if something like that might be a fit for you if you're looking for growth with no chances of losses in your own safe money retirement. Well, I'm about out of time, and I would like to thank you for listening to the Safe Money Retirement Show. If you're serious about your financial future, give me a call, and together we'll get your retirement savings on the fast track to accumulate while reducing exposure to market loss. Thanks for listening, and until next time at the same time, I'm Tim Wood reminding you to stay safe so you can step into a secure future.
You've been listening to the Safe Money Retirement Show with your host, Tim Wood. Find out how to contractually guarantee that your income in retirement is guaranteed lifetime income and not if-come. Avoid any future market losses, plan for the potential of long-term care, and make wise planning choices so you can have the retirement that you deserve. Call us now for your free copy of Tim's best-selling book, Safe Money Retirement, Your Game Plan for Success. Our toll-free number is 800-913-SAFE. That's 800-913-7233. Or log on to our site at safemoneyretirement.com for more information or to request your free book. Thanks for joining us. We'll see you online at safemoneyretirement.com. The preceding information does not represent tax, legal, or investment advice. Obviously, by contacting us now, you are only taking the first step toward protecting your retirement. No information presented today should be acted upon without meeting with a qualified licensed insurance professional. It's important that you read all insurance contract disclosures carefully before making a purchase decision. Interest and other guarantees in annuity contracts are subject to the claims-paying ability of the insurance carrier that issued the contract. The tax consequences of annuity income should be considered with the help of a licensed tax professional. Rates and returns mentioned on this program may vary based on state availability and are subject to change without notice.